To jest podcast System Trader, odcinek 109, a dziś zapraszam do wywiadu z Andrew Beer, twórcą ETF-a na strategię Managed Futures. Fundusze hedgingowe od zawsze były mocno ograniczone dla przeciętnego inwestora. Ale wraz z rewolucją zapoczątkowaną przez fundusze ETF są one teraz dostępne dla mas. Dziś, mając w kieszeni dosłownie kilkadziesiąt dolarów, można zainwestować w to, co fundusze hedgingowe. Zapraszam do mojej rozmowy z Andrew Beer, twórcą ETF-a na tzw. strategie Managed Futures. Hi Andrew, how are you doing?
I'm very well, thank you. How are you?
Not too bad, thank you. I see that you're a very early bird because it's 8 a.m. Where you are now.
I'm here at a conference, an investor conference in the U.S. and this is before the fun starts again. So happy to talk this morning.
All right, many thanks for accepting my invitation. Before we will dive into the details about managed futures and the BMF ETF, I'd like you to ask you for the short introduction who you are.
Well, sure. So I've been in the hedge fund industry for about 30 years, and the first half of that was really focused on what people normally think about hedge funds. So trying to find esoteric investment opportunities that, are mispriced by the market. The past 15 years, I've really dedicated my time, and my partner and I have really tried to figure out, if one of the problems with hedge funds is most people can't invest in them. There are incredible hedge funds out there, Millennium, Citadel, etc., that if you can put your money with them, you're privileged to do so, but you generally have to be extremely wealthy or an institutional investor. We really focused on the issue is you can't do what those guys do. What they do is very special, but there are a lot of really good things that hedge funds do that can be very valuable to the other investors, the other 99%. And so my partner and I have focused on a very simple idea, which is when do hedge funds generate something that you can then take and deliver in a client-friendly package, like an ETF in the U.S., a UCITS fund in Europe, surprisingly, it's actually very difficult to do that. Most things don't work well, so we're known as people who've really, I think, tried to approach this in a very novel and creative way that's actually worked quite well. So that's our business is basically doing that.
All right, because the listeners are mostly the individual investors. So if you could, or if you would be asked what are managed futures strategies, how would you explain managed futures in simple language to an investor?
Sure.
Or maybe does the trend following play any special role here? Because I see quite often that there's an equal sign between managed futures and trend following, but it's maybe too big simplification.
So managed futures is what I would say. So broadly, people today equate managed futures with trend following. In the same way that they equate, the underlying driver of stock picking is still the returns on the equity markets, right? If the equity markets go down 20% a year for the next 3 years, you've got to be a pretty great stock picker to go up over that period of time. So basically, this is an area that with a broad term is managed futures, and it's a terrible term, right? It confuses everybody. And so when I talk about managed futures, what hedge funds do on the trading floor, the analysis they're doing is often very, very complicated. People don't invest in hedge funds because, a stock picker has found something about one particular accounting line item that nobody else is focused on. They do it because it makes their portfolio better, right? Everybody has the same goal in this business. We want to make more money over time with less volatility, or simply, we want to grow our assets and sleep at night, right? That's sort of the broad idea. So I got really interested in this space, managed futures, because you can look at the space and say, does it help the rest of my portfolio? Stocks are great long-term investments. Until recently, bonds have been great long-term investments, right? And they may be great long-term investments from here, but I can do all of these things very easily. Open an account and get exposure to it, and Vanguard and Jack Bogle and all of these iShares, all these firms have made it so easy to access these things that 50 years ago we couldn't access. And so managed futures to me it's the best thing that we've found. Again, we're guys who for 15 years have said, what do hedge funds do well that we can then bring in a client-friendly package to your listeners, to people like that. And so, so when I talk about it with people, it's much more about, this is a strategy that's been around for 50 years. It is a strategy that sophisticated family offices have used to make their portfolios better. Institutions use it as part of they do, how they invest. And the reason they do is because it helps them to reduce the overall risk of their portfolio and potentially improve returns over time. And so you look at certain periods like 2022, when both stocks and bonds went down a lot and the strategy went up. So it's very valuable, particularly in periods of crisis. So when I talk about it in general terms, I try not to get too bogged down into what, and we can talk about what the different terms mean, but first and foremost, you have to think about why this is going to make your life better as an investor, as a person trying to accumulate assets. And for there, it's only because it's part of a bigger picture. You know, it's like putting in something to make a wall stronger, to support a stool, however you want to describe it. So that's broadly where I started. And then they say, okay, well, let's get more specific. And I'm happy to do that, sort of, go then to the next level.
So managed futures maybe sometimes sound like a holy grail of investing, because they have maybe similar returns to equities, maybe at a lower volatility. But at the same time, as you mentioned, they are mostly negatively correlated to equities. So my question is, how repeatable are the historical returns, especially for the trend following? Because we have heard so many times about the death of trend following, and I can hear it here and there so many times already.
So the whole idea, so it's not the holy grail, right? There is no holy grail. But relative to a lot of things, it's more valuable. So relative even to a lot of traditional hedge fund strategies, equity long short, discretionary macro, these things that people typically associated with it, we think it's more valuable as part of a diversified portfolio. The disadvantages are, well, first, one thing you hit on is managed futures, right? So if you're in the wealth management business and you're trying to explain to somebody what's in their portfolio and they're asking questions, that's when you get into the question where you say, oh, this is a managed futures fund. And they say, well, what's managed future? What is it? And that's where the advisor has to explain to people what the strategy does. And so let's talk about what those two terms are. Managed means what they're doing today may be very different from what they're doing in 2 months, 3 months, 5 months, 6 months. It's a nimble strategy that changes what they do. For some people, that also means unpredictable. Right. If my diversification strategy is to buy gold because I think fiat currencies are going to collapse, I can be very confident that if I'm long gold today, I'm still going to be, and I buy an ETF that gives me long gold exposure, I'm still going to be long gold in 5 years. I'm still going to be long. It feels very predictable. Gold may do nothing over that period of time. In fact, one of the great ironies last year was there were a lot of people who thought inflation would come back, bought a lot of gold last year, and gold still went down, right? So the fact that these guys change what they do is either a great thing, like in 2022, or it feels very unpredictable. And then futures is also a loaded term for people. So some people, like for me, I think futures are one of the safest instruments you can invest in, because they're so liquid, right? In March of 2020, if you owned physical bonds, they were hard to sell when the cracks were spreading in the markets. Some stocks were hard to sell or hard to trade. So I've always had this fear of, you want to be able to get out of an investment at the worst time. Can you do it? And futures contracts are almost, we've never seen a period where those markets have frozen, because in a period like March of 2020, if you want to hedge and you can't sell your bonds, you go into the futures market. So, but on the other hand, you take something like a futures contract and they're complicated. It's their notional amounts. You don't actually trade money when you enter into them. You can go long them, you can go short them. You've got to put up margin. It's much more complicated. And people talk about derivatives. Warren Buffett famously said, derivatives are weapons of mass financial destruction. Who, by the way, he is a big user of derivatives. So he's, so, again, when you're talking about bringing a strategy like this to people who've never been exposed to it, but they've never been exposed to hedge funds, they've never gone through this learning curve. It doesn't, if our goal is to help people grow their assets and sleep at night, and you introduce something that's complicated with these terms they don't understand, even if it's good for them economically, it may not help them sleep at night. And so part of the challenge with managed futures is how do we line up these statistical diversification benefits? Somebody like you who has a statistically inclined and trained mind looks at this and says, it's a no-brainer, right? But then somebody who has to explain it to people who don't have those criteria think, well, how do I make people comfortable with this as part of their portfolio for the next 10 years? That's what I'm trying to do, basically. And that's what I find so fascinating about talking to people about it is kind of connecting these two things, which I just don't think people in this industry have spent a lot of time trying to figure out how to do.
And can we say that managed futures is a separate asset class? And if so, how to define it? Because, for example, if you take a stock market, you can say you have S&P 500, for example, sure. And you can say this is the asset class, the equities asset class. How about the managed futures?
So it's a good question. So there is, the question you're getting at is you have an asset allocation pie, basically, and what are the different slices of the pie, right? And some of them are straight up asset classes. Now, a lot of people would argue, well, the S&P 500 isn't equities. It's market cap weighted, largest U.S. stocks. It's a very specific flavor of equities. But I think we all agree that equities broadly is an asset class. S&P 500 is a sleeve within that. Where this would generally fall would be into a bucket of diversifiers. In other words, things that are not stocks and bonds. And within that, I consider it to be a distinct sleeve. Now, what makes it complicated is imagine if you couldn't invest in the stocks in the S&P 500 and you could only invest in guys in actively managed funds, each of whom only owns 50 of the stocks in the S&P 500. Even though you say, what you would say is these guys on average look a lot like the returns of the S&P 500 because one guy owns stocks 1 through 50, another guy owns stocks 451 through 500. But you take them all together, it looks like the overall space, but you can't invest in those 500 stocks. That's sort of like managed futures. That's a problem we're trying to solve, which is basically, like if you say, oh, I love the S&P 500, but I have to pick which stock I like, that's very different. It's not quite as extreme in managed futures, but there is this problem of how do you end up getting access to it. And so when you define the space and you look at the long-term returns, there's only one set of data that's reliable. And that is how have the guys who've been doing this for a living for the past 20 or 30 years, how have they done on average? And so it's a very useful statistic because it gives you very good information in terms of how the strategy performs over time. How did it do during this period in 2005 and 2013 and 2018, whatever the periods are that you want to look at. But then translating that into an investable way of getting exposure to it has been much more complicated. And yeah, look, we're trying to solve that, and we're trying to figure out how to communicate it in a way to people that they're comfortable with it as a strategic allocation.
And who should be interested in adding managed futures strategies to portfolio? Let's say we have individual investor who read and learned from Jack Bogle, and the person is having already equities and bonds in the portfolio. How about this person? Should such person be interested in adding managed futures to the portfolio, for example?
Well, I wouldn't go so far as saying should, because I think everybody has their own preferences, right? I mean, Warren, they asked Warren Buffett, if you didn't have Berkshire Hathaway, what would you have? And again, Warren Buffett has great tolerance for risk, and he said I would have 95% of my portfolio in the S&P 500, and then 5% in cash, right? And so everybody has their different preferences. If your goal is I want to grow my assets over the next 30 years as much as I can, and I'm not going to look at it for the next 30 years, then you probably want 100% equities. You can look at hundreds of years of data. Equities should do better because they are a lot riskier, right? So if you're willing to take the risk, but I think most people who've accumulated some wealth through their job, through the appreciation of their homes or whatever, they're not looking to swing for the fences. Stability is very important to them. So, and I think, by the way, look, I think what Bogle has done, I think the growth of model portfolios, I think getting people to focus even on 60-40 portfolios. Spencer Jacob from the Wall Street Journal had another great article today on 60-40 portfolios. Eric Wallerstein from the Wall Street Journal did it a few days ago. These are 60-40 worked miraculously during the 2010s. That basically 60-40 portfolio outperformed 95% of hedge funds or more. Wow. I think that we actually ran the statistics. I think it was 98.5%. I mean, it's ridiculous. It did ridiculously well. It's not going to do as ridiculously well over the next 10 or 20 years. So what do you add to it? Where a dollar that you're taking from your 60-40 portfolio adds value to the rest of the pie. And you can measure that. If I take it from my bond side and I say, well, I'm just going to put it into high yield bonds, you're really kind of adding equity risk, right? I mean, high yield bonds and equities kind of move up and down together because they're kind of risky like equities. If I move it from the S&P 500 to European stocks, well, you're still taking European equity risk. So what do you have that you can put that diversifies both stocks and bonds over time? And I think managed futures it's just the best thing that we've found to do that. So for each of those investors, if you say, what I really care about is adding something to my portfolio that I think is going to help me over the next 10 years, over the next 20 years, then I think that person should add managed futures. And the question is, is it a 5% allocation, a 10% allocation? Some people go up to a 20% allocation. I don't think anybody in their right mind should have 100% of their portfolio in managed futures because it's too unpredictable, like a lot of things.
All right. I'd like you to talk about the DBMF ETF. Do you think that as John Bogle, for example, changed the industry, you will also impact the hedge fund industry where such products are typically more expensive? I read in August in Morningstar that the average total expense ratio for the hedge funds is around 1.6%, whereas, for example, your ETF is 0.85. So I'm just asking the question because, for example, Steve Jobs, I know it's a totally different industry, but he said once that if you don't cannibalize yourself, someone else will. Do you think that the same thing may happen to hedge funds with the higher costs? And by the way, you have a very nice saying, in hedge funds, fee reduction is the purest form of alpha.
So I think the hedge fund industry, well, first of all, let me start with saying, I mean, to be included in the same paragraph, the same page, the same chapter as John Bogle is an extraordinary honor. I mean, I say about John Bogle that man has made more money than the 100 best hedge fund. He's made more money for investors than the 100 best hedge fund managers over time. He's just done it $1 at a time, not $1 million or $1 billion at a time. I mean, it's dispersed across hundreds of millions of investors. I think people, what we're trying to do, and I have, for compliance reasons, I actually can't talk too specifically about. So we manage an ETF in the U.S. We also manage a UCITS fund in Europe that follow the same strategy. And what we're trying to do broadly is similar to what Vanguard does. In that Vanguard's initial model was, I want exposure to equities, but I don't want to try to pick which guy is going to outperform the broad market indices. In other words, because I have to pay a lot for that, right? And if every time I picked a guy who's going to pick and he picked the best stocks, there never would have been a Vanguard, right? The problem is you pay a lot of money for the guy and he doesn't pick the best stocks and you do worse than you could have done if you just bought the index. And there's decades and decades and decades, and Morningstar has been a leader in producing this data. So what we're trying to do in this broader managed future space is create an access point for investors. We're back to your point about somebody's got a whole portfolio, and they've got their stocks, and they've got their bonds, and they've got, maybe REITs and or real estate, publicly listed real estate stocks, and a bunch of different things. And then they say, and I want this because I believe this is going to help. This being managed futures, trend following, however you define it. Can we create a way of getting index-like exposure to it? And I mentioned by saying, in this space, when they say an index of returns, how is this done over the past 20 years? What you're saying is, how have most people would say, how have the 20 largest guys in the space done? How did they do on average in 2022? How did they do on average in 2021? That tells you the underlying value of the space. And so our model is basically that we think we can figure out with great accuracy the big things that those guys are doing and copy it cheaply. And that if we do that right, then our returns will look a lot like that index. But one of the, when you talk about what Vanguard did, people often say, this is what the index did, and the average active manager underperformed it, right? You could flip it around and say the average manager did this, and just by being cheaper and more efficient, Vanguard outperformed 95% of them, 90% of them, whatever the number is over time. So when people talk about fee reduction, they often think about, well, if I invest in the hedge funds and I pay a lot of money, I'm getting something pure. That's great. And as long as they're generating all of this alpha for me, I don't care about paying really high fees. Statistically, just like stock pickers, most of what you're paying them goes to them and doesn't come back to you. And so the argument of lowering fees and doing things efficiently is we want our clients to do better, right? And if our clients do better over time, then they can use our funds and say, hey, I want a 5% allocation in this space, and I want to have it now and 10 years and 20 years in my portfolio. I don't want to have to worry about who to pick in the space, who's the right guy, who's going to do best this year. I don't want to pay a lot of fees to everybody for it. I want to come in with I just want to get exposure to the space, and through lower fees potentially outperform the space. And that's what we're trying to do. And so that's the analogy to, outside of just Vanguard, it's trying to create a product that is it's like an index. It's as close as we've been able to get to something that's index-like exposure to the space.
So could we say that you try to deliver something similar as, for example, S&P 500 is delivering to equity investors, just the average of the market, in that case of the managed futures strategies? Am I correct?
Well, except the hope is, right? So again, when you imagine if the S&P 500 had 300 basis points of fees built into it, right? And so you look at the S&P 500. So S&P 500 did 13.5% per annum in the 2010s. Okay. What if the only way to get access to the S&P 500 was to pay 300 basis points a year? And you look at it and say, how did the S&P 500 do over it? Well, through this investment vehicle, it did 10.5% per annum. And then somebody comes along and says, actually, we can get you 13, maybe not all 13.5% that the S&P 500 did before fees. So we can get you 13 and we're willing to charge less. And let's say instead of 10.5, we're doing 12 or 12.5%, just by giving you access to the same underlying asset class exposure, but more cheaply, you'll outperform, right? So it's not average. It's actually, and if you outperform, you would, and then you look at all those products out there that cost 300 basis points for the S&P 500, you'd be one of the top performers, not by being smarter, just by being cheaper. And so I think there's often this thing about cheaper is always better. There are a lot of terrible cheap products, right? There's one, I was talking to a journalist yesterday about a kind of a hedge fund product and a mutual fund in the US, and it's got $1 billion in it. It's done zero since it launched, right? And the money that it got taken from was a 60-40 portfolio that's up 50% over that period of time to put that $1 billion in. So that diversification decision cost their clients $500 million over the past 6 years. And it's cheap. No one cares that it's cheap if you've lost $500 million. So I think this whole idea of average, I think, and this idea of reducing fees is a proven way. If you can get exposure to hedge funds, but do it more cheaply and not lose what you wanted, what you're trying to get in the first place, then you should outperform over time. And that's our goal, right? Our goal is to outperform through efficiency.
Okay, if I understand you correctly, what you do behind DBMF, you just apply some reverse engineering process, and based on that, based on the past returns of some funds, you just come up with the current state of the portfolio. And if I remember, you just do the rebalancing once a week. My question is there a risk that DBMF at some point will react too slow to some rapid market movements?
Sure. Of course, right. So we have so ours is a simplification, right? And there are two. So just to take a step back, what anybody who reads the newspaper and looks at the markets, right? There are two sort of very obvious observations, right? One, every asset class does one of three things. It's either going up, it's going down, or it's not moving at all. Right? That's it, right? Stocks and bonds are up or they're down. Maybe one's going up, one's going down. But you could have a million different instruments out there, and they're not going in a million different directions, right? And so that's observation number one. Observation number two is that when we talk about these different asset classes and different stocks, there's usually some underlying force that's causing them to move together. So if we are in a commodity super cycle for the next 5 years, if horror breaks out in the Middle East and we have embargoes or whatever else we have going on again, and oil goes up to 250, heating oil is not going down. Natural gas is not going down. Jet fuel is not going down. Like, things move together for a reason. When interest rates are going up in the U.S., it's not like we have lots of inflation in the U.S. and the rest of the world has deflation. The whole Western world has inflation. So that's going to affect every major market. So a lot of the way people talk about strategies is the storytelling around individual positions is very compelling. The wheat markets are going up because, somebody's tractor broke in the Midwest or something. I mean, but in reality, you can have lots of different things, but they all kind of move up and down in clusters. And so what our strategy is basically we look at this broad space and say, what are the big trades? If they're betting on interest rates going up, in a complicated way, you could bet on U.S. interest rates going up. You could bet on the front end, the middle curve, the back end of the curve. You could do the same thing with the UK. You could do the same thing with Germany. You could do the same thing with a lot of different areas. But our approach is basically, okay, but that's the same underlying bet. It's actually pretty much the same. So if that's the bet, that's also, from our perspective, maybe we only need to use treasuries to get effectively the same bet. It won't be perfect, but over time, it's going to be pretty damn close. But what it also means is that we're only trading in the US, which is the safest place to be trading. We're not trading globally in different markets, but in terms of liquidity and everything else, our trading costs are much lower, so it's much more efficient. And it's a little simpler. We can kind of see what's going on in the portfolio. Now, the next question you asked is, but in order to figure out those big trades, none of these guys is calling us on Monday morning and telling us, by the way, we've shifted our portfolio last week. This is what it looks like, obviously, right? Proprietary information. But you can look at their recent performance, the recent performance of these indices, the recent performance of mutual funds, the recent performance of UCITS funds, and you can run that through a risk model, which is what we're basically in the risk model business. You run it through a risk model, and you can figure out what they think are the big trades. Now, you're right. We only do that once a week. We could do it every day. It turns out that these guys don't move their portfolios that fast because people have said, well, okay, so when you're doing this, though, you're only looking in the rearview mirror. Okay? And my answer is, so are they. This whole business, when you talk about trend following, they're following trends. they're analyzing data. They're analyzing price moves of things that have happened over 2 months, 3 months, 6 months, 9 months, and using that to infer whether crude oil is going to keep going up, whether gold is going to keep going down. And so out of that longer period of time, we're looking at very recent history. So they will change, and we might be a little bit slower than them at certain inflection points. I think we were a little bit slower than them in March, but it's not, but what we always tell people is, people like to look at and say, well, oh my God, if they're faster than you are, then you can't possibly copy that. The answer is that sometimes things that they do are mistakes, right? Sometimes they are faster, but they got head faked by the market. Sometimes they are faster, but again, we're talking about days faster. We're not talking about months faster than we are. So it's a judgment call. Look, anytime you're building a model, anytime you're building an investment strategy, you have to make a judgment call. And for us, we looked at it and said, we do it once a week. It works damn well. We can do it daily. It doesn't seem to improve the results. You don't get enough information day to day to make it worthwhile, but you can potentially drive up your trading costs. So our judgment call is that for the time being, the way the industry is structured, doing it weekly works just fine.
And how many futures contract is enough to replicate well the managed futures?
So a typical managed futures fund might on average use about 70, 50, 70, kind of 100 in that range. Awkwardly, you can do it with 4.
Wow.
And so I published an article in Institutional Investor. So in the funds that we manage, it's generally about 10 core big positions. Sometimes because of the rules, the way the fund rules work, sometimes instead of buying asset A, you have to buy asset A and something similar to it to kind of get the same kind of exposure. But we do it with about 10 core positions. But the key is that there are 4 major markets that these guys invest in, and they invest in equities, rates, currencies, and commodities. And so you want to be exposed to each 4. But what I did, so when we started doing it with 10, the people who criticize what we do are the people who run funds that charge more than we do, not surprisingly, right? Because this whole business has been on a 30-year path toward commoditization. Right, that one firm figures something out, a person leaves there, starts a new firm, then somebody who works for them starts a new firm, they trade ideas, they publish papers, like it's not, information gets disseminated, more and more people know how to do it. But people would say, well, 10 is too simple. You need 70 because there are all these other instruments and sometimes every now and then, some of those instruments do add value that we're not going to pick up on. Most of the time, 90% of the time, we don't think it really matters. And so I wrote a paper basically saying, it's not a question of 10 versus 70. You can do it with 4. As long as you have exposure to those 4 major markets, you can actually do a remarkably good job. Because if you think about it, people talk about the 2-year and the 10-year and the 30-year treasury, but it's yes, there's going to be some movement in the curve. But the big thing is the fact that the whole curve has gone up. And so you're going to lose some nuance in what you do. Now, we didn't do it. We first looked at doing it with 4 factors back in 2015. So 4 instruments. It felt too cute to us. It felt that just using the S&P 500, what if the world becomes very, non-US stock centric, and that's where the great opportunities are. So we expanded it to what we thought was a reasonable amount, which was around 10. But again, it's designed to be very, very, very simple relative to hedge funds to do this.
So you don't have to have the futures contracts on orange juice because it was recently on the media because of the high returns. My question is now about the interest rates, because, for example, in the 80s, especially the trend following funds, when I was reading about them, a big part of the profits were coming just from the interest rates. And typically on the futures contracts, for those who doesn't know, who are listening to us, you have to only have capital for the margin deposit. So let's say 70 or even more % of your capital can be just not invested. So my question is, what happens to such capital in the case of DBMF? Because you also just need capital for margin deposits, so then a large portion of that capital may be uninvested.
Yeah, so from a nominal returns perspective, we love higher short-term interest rates, because if you look at the balance sheet of our funds, it's short-term treasuries, short-term instruments. I mean, it's basically, so when that's earning zero, we're earning zero on a huge percentage of our assets. When it's earning 5, we're earning 5 on a huge percentage of our assets. So one of the challenges that the space had, the space overall went through a lousy period in the 2010s. Basically, over a 6 or 7 year period, it made no money for anybody. But what I've said, it made no money for clients. Okay, so there are two differences. One is that, first of all, interest rates were zero. There are three things that happened. Interest rates were zero. The Fed put the degree of the Fed's engineering of the markets during that period of time was tough on this strategy. It was like, in the same way that that driving interest rates down to zero caused disruptive tech stocks and profitless companies, etc., which are really bad for value investors if all the money is going into tech and other things like that. In the same way that like the Fed's activity kind of made it very difficult for value investors, it also made it difficult for trend followers, because currencies were in a band. All central banks were working together. Currencies were in a band. Interest rates were all kind of in a band and lower together. So so you had very, very low interest rates. You had a tough Fed environment. And for most funds, you had high fees, right? So if you're only generating a little bit of alpha each year, but your fees are as much or greater than the alpha that you're generating, yeah, investors are going to get pissed off after a while, which is what they did. So I think going forward, I think all three of those things, well, the first two we know have changed, right? The interest rates are higher. So if the strategy does nothing but cash plus 1 net of fees over the next 5 years, and interest rates stay where they are, you still make 6, not 0, or not 1. Secondly, the Fed put's gone, right? So the moves that we've seen in the markets tend to be better for guys like trend followers, because they tend to be bigger. So the waves in the markets are bigger than they were before. They're bigger and longer and more sustained. And then we're trying to solve this fee issue. That basically we don't do what we do for free, but we do it for a lot less. And the idea is that if we're 70 or 80 or 90 or 100 basis points cheaper than a competitor product, and we're doing a good job on the replication side, 5 years later, that's going to translate into a similar amount or more of outperformance relative to what they're doing. And if you're a long-term investor, those little changes in fees, those little, it just compounds over time. It's really, 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 really valuable.
Can you say us, I don't know if there are any compliance restrictions, but can DBMF, for example, serve as an alternative to bonds in classical, model portfolio where you have stocks and bonds? But if you would just remove bonds and put their DBMF, for example, do you think it makes any sense to you?
So we've done the analysis. So the crazy thing, right, is this strategy. And again, when I say this strategy, it's a little bit theoretical, because you can't actually easily invest in strategy. Again, we're trying to solve that, but you have to believe then that we're doing a good job of solving that. If you'd had this, a 60-40 portfolio between stocks and managed futures instead of stocks and bonds, even through the great bond bull market, you would have done better. But I've been doing this long enough to know that, it's what Niels Bohr said. It's very difficult to make predictions, especially about the future. I would never recommend that somebody does that. I think the value of this is it's a 5% or a 10% allocation in a portfolio that has stocks and bonds and other things, because we just don't know. And particularly in the world today, I don't know. The world doesn't seem terribly predictable to me today. I think if you dial back to end of 2019 and said, here's our playbook over the next 4 years, we're going to have a global pandemic, governments are going to shut down, countries are going to shut down all over the world, international travel is going to stop, interest rates are going to go to zero or negative. And in the context of that, tech stocks are going to go through the moon, and we're going to have a land war in Europe, and we may have a, even greater conflagration in the Middle East, and so on and so on and so forth. Oh, and the S&P's up over that period of time. Like it's just like, who would have, you can't make this stuff up. So I think, going back to where we started, which is, how do you sleep at night? Is you sleep at night through diversifying. Now, diversifying is not fun. Okay. What's fun is betting it all on Bitcoin, or that's the serotonin hit from gambling and trying to hit. In the U.S. we call them hitting home runs, but basically hitting the lottery, buying lottery tickets. That's diversification. The annoying thing about diversification is there's always something that's not working. That's the point, right? So, you started asking sort of question about managed futures. One of the challenges is that there are plenty of times when managed futures is not working, and it's going to be your least favorite investment if you stare at it a lot. By 2019, after this long period of frustrating returns, 2020, a lot of guys who'd been in the space for a long time were getting out. They were selling, and they missed 2021 and they missed 2022, which was, so the point of diversification is that not everything's supposed to be working at once. And
right.
Ironically, with 60/40 portfolios and diversified portfolios, what we call the great head fake, because when over, from 2000 through 2021, basically, both stocks and bonds were going up over that period of time, right? Equities had a rough 2000, then a spectacularly good 2010s. Bonds had a incredibly good 2000s and a great but not as great 2010s. But they were going up over the whole period of time. And so, but they were going up at different times, and they were inversely correlated. So 1 month you're making money over here, the next month you're making money over here, but the ball is advancing the whole time. That's not realistic, right? It's not realistic for your diversifiers to always be going up at the same time as the things that they're supposed to hedge. But people got conditioned upon it. And in fact, the modern wealth management business, in a sense, was built on this idea that it's easy. Yes, you'll make money on both your stocks and bonds, but you'll just happen to make money in different months. And so your ride overall will feel smoother. Spencer Jacob, in his Wall Street Journal article today, pointed out that, on 60/40, pointed out that from 1965 to 1982, you had a negative real return in a 60/40 portfolio. The S&P 500 right now is everybody's easy default allocation. U.S. stocks are now 60% of global stocks, so because they keep going up and nothing faster than everything else. But the PE on it is is higher than it was back in 1965, 1966. It's kind of at historically high levels. So people could be in for a period where things where they were very easily used to making money could go through years, a decade of not making money. People have forgotten that in the 2000s, the S&P lost money on a total return basis. NASDAQ was down 40% over a decade. So people got so spoiled by the world in the 2010s that they think it's easy. And so my argument is we really don't know how this is going to play out. Macro guys who've been doing this for a very long time are very, very worried about the state of the markets, the state of our political situation. We've got a clown show in Washington, D.C. These guys can't figure out how to do any policy anymore, other than kind of jamming things through in certain ways. So so in the context of that, I think I'm just an advocate of sleeping at night is doing a lot of different things, and we're one small component of that.
Right. I think that also among individual investors, there's not so much of understanding because, for example, managed futures or having managed futures in portfolio, you look different than if you have equities, for example. And for example, in the previous year, where managed futures had very great results, I already saw comments that in 2023, managed futures like, for example, DBMF is around 0, I think, year to date or something like that. Whereas, for example, S&P is around plus 10%, and they don't have this understanding, at least from my observations, that this is, in fact, the advantage of having them both maybe in the same portfolio, that they are just working in a different way. I wanted to ask you about DBMF, about the benchmark. I know there's no official benchmark for DBMF, but can we use any benchmark anyway to compare it? For example, SocGen Trend Index.
So the, as I said, we think the gold standard of, if you ask an institutional investor, how did the managed futures space do last year? They'll tell you the SocGen CTA hedge fund index was up 20%. What they mean is this is an index that's been published since 2000, which is basically the average returns net of all hedge fund fees, net of all expenses of the 20 largest hedge funds in the space. It's not easy to get the information on it. You can get the information on their website. They do have it, but it's not, it's really an institutional benchmark. So one of the things we've actually spent a lot of time thinking about is, if you want this space to become an easily accessible, like you S&P 500, you want to know the returns on it? A million places you can get that online. A million databases. It's everywhere. You just click a button, you hit the ticker, and you click a button, it's there. Managed futures is not that easy. So part of the challenge, I think, if this is going to become one of those mainstream asset classes, you've got to have an easier way of finding benchmarks. And so, yes, you can look at, if you were to say, what do I think is the industry standard? It's definitely the SocGen CTA index. There's a firm called Barclay Hedge, which is different from Barclays, the investment bank, that also has an index that is, I think it's the B Top 50, which is equally good. It just depends upon where you can get the data. From our perspective, people generally will benchmark us versus the SocGen CTA hedge fund index, because we're essentially trying to give you a 90% correlation to that, but outperform from efficiency by a few hundred basis points a year.
All right. By the way, with the BTOP, it has a much longer history, so it's better, at least for quant.
Yes and no. So the problem is that the modern hedge fund database business, I wish the numbers were real, right? The problem is the modern hedge fund databases. I should say, Barclay Hedge may disagree with this, may have a strong counter argument. Almost every hedge fund database that I've looked at closely, by the time you get into the 1990s, there's something called selection bias or survivorship bias. So what happened, the way they used to construct these indices is, in 2004, you're going to add something to your index, but the guy you're adding to your index has done much better than everybody else over the past 10 years. That's why he's being added to your index, because he's been on a hot streak and people are throwing money at him. The way they used to take these indices is they would then add back his numbers, these even better numbers. So every time they'd add somebody who was great, the historical numbers would keep going up. So it is quite possible that those numbers are pure. I don't rely on them. I think the modern quality data starts in 2000, and you go back earlier than that, the data gets murkier. But I know that people use it, but I don't. Yeah. So.
Right. Yeah. It's always with the data that, if you put bad data as an input, you cannot expect that you will have a nice output. What distinguishes you from the competition? For example, I see another ETF, KMLM, which is also quite successful and popular. What are the main differences between DBMF and KMLM, for example?
Sure. KMLM is a great product. Okay, and hats off to Mount Lucas. I'm going to actually go visit with those guys tomorrow. And I think that people ask me, I think they've done it right. So what KMLM does is basically, they say that the core underlying driver of this is simple trend following models. Now, what do we mean by trend? We mean you look at the price moves over a longer period of time and a shorter period of time, and you evaluate those two to determine whether you think something is likely to keep going up or going down. And so what they've done with KMLM is they've codified that. And they basically, and so you can actually see exactly what they're doing. You can see what they're doing and what they're not doing, right? And the numbers have been fantastic, right? They did better than I think most people would have thought last year. They're having a great year this year. So we looked at doing that. We could do that, right? We have the capability of doing what they do. We didn't do it for the following reason. This industry, we think, does evolve over time. And so theirs is very much a strict index approach, but when we looked at it, we said, what if those guys in the SocGen CTA index meaningfully change what they do over time? How do you keep up and change them? You cannot go back and keep changing your index, right? So the index has been working fantastically recently in a world with these very, very big trends. But if the world changes, how do we keep up with them? So we made a decision that basically that we would we would look at what they're doing every week. So if they're changing and they're evolving what they're doing. So here's an example, right? AQR is, again, astonishing firm. They've been in this space forever. 7 or 8 years ago, they had this mutual fund in the US that had $14 billion in assets, smartest guys in the room, etc. They have meaningfully changed what they do, right? So back 5, 6, 7, 8 years ago, they would have said, we're trend following or something effectively like that, maybe some other trades in it. Now, they basically pushed away from the traditional trend following to look at alternative markets. What are alternative markets? It's not even orange juice. It's presumably things like carbon credits or things that are like harder to access, harder to implement, which makes perfect sense, right? I mean, that's what you should be paying hedge funds to do, is to find stuff that's less easy to access. Because if we can do this, right, why would you pay everyone a lot of money to give you the straightforward stuff? And they've even expanded it to look at momentum in like macroeconomic signals. And I don't know exactly how they do it, but that's a big shift in what they're doing. And they started doing it in 2022, and their numbers look great. Right? Knowing this space, people criticize us because they're like, you're just copying everybody else. Everybody in this space copies everybody else. No one in this space says, they've got a great idea over there, but I don't feel right. Of course, everybody, it's the whole hedge fund industry. Everybody copies each other when there's a good idea. I'm not going to do subprime because, I wasn't the first guy to think of this thing. It's crazy. So, but now imagine a world where that does keep to do well. So we've studied this AQR fund recently, and we think you can actually replicate it even if you move in that direction. But the question is, with something like KMLM, which really can't change its playbook over the next 5 or 10 years, will it be the right way? So my answer to people is, I think what they're doing is great. I think what we're doing is great. You can probably be perfectly well off picking either one, or you can combine them. And I think what you'll see is more and more people combining them and saying, here is a great way of getting this kind of long-term simple trend exposure, but to the extent the industry is more dynamic, to the extent there's more opportunity in the way we do sort of the fee disintermediation, then you can put them side by side. But think about how great that is. Like, you've got these two ETFs out there that, because historically the whole hedge fund strategy in an ETF world is tiny, and it's tiny for a very good reason. The products suck. The average product out there, when people have said, oh, it's great, we're going to put it into an ETF, 3 years later, everyone hates it. 5 years later, everyone hates it. And so what KMLM, what Mount Lucas or Crane Shares are doing on that, and what we're trying to do is basically say, no, if you think about it the right way and you get it right, you actually can create good products where people will be happy with it. And so that's such a positive thing for it. And then it'll eventually start changing people's perception about this idea that you can't do hedge fund strategies in ETF, which, by the way, it's not only based on the evidence, but it's also promulgated by people who run more expensive mutual funds. Generally don't want to see success in the ETF world.
Okay.
AQR, actually, amazingly, Man AHL actually just launched an ETF several months ago, But I think what they did is they basically said, tried to make it simpler than their mutual fund, because it's going to be really awkward for them if their lower cost ETF does better than their mutual fund or their really expensive hedge funds. That's kind of you mentioned Steve Jobs and cannibalization. People in this industry don't like cannibalization. I mean, it's people in this industry actually, they're innovators, but once they become established, they don't want change. They don't want new innovators to come into it. Certain firms like the great quant firms like Renaissance or D.E. Shaw, they start with the assumption that every opportunity they find is going to have a very limited life, so they've got to keep evolving what they're doing. But from an economic perspective, I mean, look at the active management industry. They have fought the growth of indices and ETFs for 40 years because they've got to preserve what they have. And so it's always that complicated ethos.
All right. I have a question which maybe will sound strange to you about distribution of dividends, because DBMF ETF have to distribute dividends at least once a year, and this is generating a tax event. So is it really needed by law, or is there any specific requirement that you have to distribute profits as part of the dividends?
Honestly, I will defer. I will dodge that question because A, we're the sub-advisor. We don't actually manage the fund, and B, I am not a tax expert and regulatory expert. I would say, as a general business matter, when U.S. regulated investment vehicles, ETFs or mutual funds, have taxable income during the course of the year, they tend to distribute it.
All right.
And I think the idea is that if they don't distribute it, then you own an ETF and you suddenly get this tax bill for it that they haven't given you the cash to cover. And I think people just don't think that would be a right thing to do. So as a practical matter, the managed futures space, if you make $10 in the course of a year, just the way it works, it tends to be taxable, so they tend to make distributions on it. I don't know if that would be the same thing because we now manage, since January this year, we've managed a UCITS fund that follows the same strategy. I actually don't know if that would apply in UCITS world as well. I know they have like distributing share classes and accumulation share classes. It might be different.
All right. And by the way, once you mentioned the UCITS, I know that you have the clone version of DBMF in Europe, but it's not ETF. So my question is, are you planning to introduce DBMF but wrapped around ETF? Because at least even from my point of view, it would be easier to access it.
Sure. So we looked at ETFs. I mentioned that the U.S. hedge funds in an ETF is still tiny and, in a sense, in its infancy in the U.S. And the U.S. is 10 years ahead of Europe in the ETF world. So I think if we're having this conversation in 10 years, I'm pretty sure we'll have an ETF. But it requires, there are a lot of complications with ETFs. So when an ETF is small, for instance, you can find somebody who loves the investment strategy, but is uncertain as to how to buy $5 million of shares in an ETF. And I don't know enough about the ETF world in Europe, but from what few conversations we had, we've got to let it evolve a lot more. So the easy thing to do is, because most of the people who we would expect to be interested would be wealth managers and institutional investors. And for them, investing in UCITS funds is seamless. It's easy.
Okay, so let's talk in 10 years about that topic of ETF, UCITS ETF. We are reaching to the end. I have just one actually final question to you. What do you think about ideas like portable alpha or return stacking? So kind of managed futures on steroids, I would say. So basically you can eat cake and you can have the cake.
I think they're all very absolutely clever ideas, right? And so one of the great things, and if I was running an institutional portfolio at a pension plan, I would be asking questions like, why am I handing $100 million of cash to this hedge fund to sit on cash for me? I may have a better way. I've got a fixed income team over here who has a way of managing it, and they're going to make another 100 basis points. So like capital efficiency and eking out incremental dollars is very valuable. I think it's, I think for 99% of wealth managers and investors, it's the simpler approach is better. So we want, where I'm focused is on guys who are like, we love 60-40 portfolios. They've worked tremendously well. What does a 55-35-10 portfolio look like? What does a 50-30-20 portfolio look like? And what are the best things we can put in that? Capital efficiency, again, it was also, I think, like return stacking was also a function of the tail end of the 2010s when you weren't really earning things on the fixed income side of your portfolio. It's a very, very interesting idea, but what I've tried to do is put myself in the shoes of a typical wealth manager, not individual investor, not somebody who wants to swing for the fences. And a lot of the way I would think about it is risk management. How do I explain to my clients, if the S&P 500 goes down last year, they don't blame you for having equity exposure. Everyone thinks you should have equity exposure. Even bonds going down, unless you were loading up on, Austrian 100-year bonds or something and, got absolutely smoked. You're given a pass for all of that. When you start doing more complicated things, a lot of the hesitation that people have is, how am I going to explain it if it goes wrong? And so return stacking and portable alpha introduces an element of leverage, right? So notional leverage so what happens if, for instance, you have it stacked on top of equities, and during a period of time where managed futures and equities are positively correlated, which happens, and equities go down and managed futures means you go down more. It may feel like a low probability scenario today, but if I were a financial advisor thinking about how I'm going to explain that to a client who needs this money, things like this mean that it may be hard for them to buy the vacation home, to retire 2 years earlier, to things like that. It's not pension plan money where it's all actuarial games. This is people's lives. And I think my guess is that it's going to have great appeal to a very specific audience because it's solving something that they want solved. But my bet is that 95%, 98% of people are willing to take the simpler, more straightforward solution. But as I mentioned in the beginning, I've got to find a way for the average advisor. I can talk to guys who, if I talk to a guy with a PhD about what we do, there's no hesitation. Of course it works, right? I mean, it's sort of mathematically obvious. It's obvious if you've been in the markets. But if I talk to a wealth manager, he's got to be able to explain why we have this, how to think about it, what the expectations should be. Otherwise, his clients are going to be nervous about it, and they're going to stare at it. And that's going to make his life more difficult. And so that's the challenge. I mean, it really is it's a marketing challenge as much as anything. And so I think these concepts, at least I'm very focused on how do I make the advisor's life better? How do I make them feel like they've been a victory more so than and I think that's the vast majority of people. But we'll see. If those guys are right, then we'll look like fools in 5 years.
Yeah, I think that for average individual investor, simplicity is very important. Also from the behavioral point of view. Andrew, thank you very much for your time. Very appreciated. Do you have any final words before we will finish this conversation today?
Well, I don't know. I've thrown out a lot of words already.
Yes, quite a few.
Look, I think this is it. I think it just goes back to, I think for everybody who's listening, right? I guess a word of advice is, people throw around views of what's going to happen in the world over the next 3 or 6 months, and they do it because it's their business, right? So people defending, saying 60-40 portfolios, we're going to go right back to a world where stock and bond correlations normalize and bonds are, remember, the questions you should ask yourself are really twofold. The first is, does this person have skin in the game? Is there a reason they're pitching this to me, right? I am pitching to you my things, and you should fully understand that I'm economically motivated to convince you that what we're doing makes sense. I think the fact that, but hopefully you'll hear us talk about it and it will make sense, and we'll build your trust that we don't have any crazy ulterior motive. We can kind of evidence it. But the other thing to ask yourself is were they right before? What was their last call that they said with great certainty? This year has been very humbling for people. So the people who are saying, bonds, best time to buy bonds, were they also saying in January, taper, second half of the year, this is the year of the bond, right? They were flat out wrong, dead wrong on that. And so I think the way media and communication is set up today is that people forget about past calls. And so I would just be to the average listener, I would just be very wary of people who express with great confidence what the world is going to look like in 6 months. Because I don't know anybody who predicted some of the major shocks that we've gone through. I mean, the smartest people in the world about Russia and Eastern Europe seem to have missed that conflagration. I don't know anybody. I mean, if the Israelis missed what's going on in the Middle East, I mean, who are we to make confident predictions about what's going to happen from here? And so but it's hard for people to sit with uncertainty. But your best protection from uncertainty is diversification. And it's not the outcome everybody wants, which is to have, every investment you make does great. But I think a lot of people who've been doing this for a long time think the state of the world we're in right now, unsustainable budget deficits, the U.S. government who can't stop spending money, global conflagration, deglobalization, all these big trends out there, not good. And so this really may be a time to think about diversification, preservation of capital, embrace what we don't know, and stay liquid, give yourself flexibility. But again, look, 2 years from now, the S&P 500 will be up 75%, and I'll look like a fool, but that's okay. It's happened before.
And by the way, I haven't asked you that question, but is it true that most of the funds you replicate, they use the systematic approach rather than discretionary strategies?
Yeah. Everybody's systematic. Yeah.
Okay,
it's just different flavors of systematic. Yeah.
All right, but the conclusion is they don't try to forecast anything; they just follow some process, and
that is essentially the rule, right? And so in a sense, I mean, this is a weird space, right? In that people look at. I actually was talking to a journalist about it yesterday, and she said, "So, what are the CTAs telling you about where the world is going?" And I said, they're telling you where the world has been, and the belief is that that's a good predictor in the short term as to where things are going. But these guys are not making calls as to how many more Fed hikes or we're going to have or not, or when taper starts, or when the U.S. economy hits the windshield from higher rates. So it's actually a pretty lousy strategy from a storytelling perspective.
Very boring as well.
It's a limitation, but it happens to work, and that's the sort of incredible thing about it.
Storytelling is very important if you want to sell something. So that's why also.
We don't have good stories to tell, but hopefully we have good numbers to report.
Right, exactly. Okay, Thank you very much, Andrew, for your time. Very appreciated.
Thank you so much. Okay.
Have a good day.
Have a
Bye-bye.
wonderful day.